Hey everyone, welcome back to Corporate Decoder. Today, KHC has filed its annual report on Form 11K, and we are diving into what the Kraft Heinz Union Savings Plan is telling us about the company's financial health. Quick note, this is not financial advice, just my take on public filings for educational purposes. This filing gives us a peek behind the curtain of a major employee benefit plan, and some of the numbers here are worth paying close attention to, especially when looking at how the company is managing its retirement assets. So, what exactly is this document? It is an annual report for the Kraft Heinz Union Savings Plan. Think of it as a detailed financial checkup for the retirement savings of many of Kraft Heinz's hourly employees. It breaks down how the money in this plan is invested, how it is grown, and what expenses are involved. Let's jump into the financials. The core of this report shows us the plan's net assets available for benefits. This is basically the total pot of money set aside for the employee's retirement. For the 31st of December 2025, the plan reported total assets of $341,847,000. That is a significant amount of money. Comparing this to the 31st of December 2024, where total assets were $312,328,000, we see a healthy increase of almost $30 million. A huge chunk of this money, $316,160,000 in 2025, is invested in something called a master trust. Imagine this as a really big investment pool where Kraft Heinz's employee plans combine their assets to get better investment opportunities. This trust holds various investments like collective trusts, registered investment companies, and of course Kraft Heinz's own stock. The fact that this number grew from $287,284,000 in 2024 shows that the investments within the trust are performing well, adding value to the employees' retirement funds. Now, how did that net asset figure change over the year? The statement of changes tells us the story. For the year ended the 31st of December 2025, the plan saw additions to its net assets totaling $70,692,000. This came from various sources. The largest piece of this was $41,151,000 in net appreciation from the master trust. This basically means the investments within the trust grew in value. This is like when your own investments go up in price. On top of that, there was $895,000 from interest and dividends from the master trust, showing that the investments are also generating income. Employees themselves contributed $16,021,000. That is a good sign that employees are actively saving for their future. There were also $650,000 in rollover contributions, which is money transferred from other retirement accounts. And importantly, Kraft Heinz contributed $11,339,000. This is the company matching or contributing to their employees' retirement. Finally, there was $636,000 in interest from notes receivable from participants, which are essentially loans given to employees from their retirement accounts that they are paying back with interest. On the other side, the plan also had deductions, totaling $40,639,000. The biggest chunk here, $40,325,000, was for distributions and withdrawals. This is money employees are taking out likely because they retired, left the company, or met certain withdrawal conditions. The plan also paid $314,000 in general and administrative expenses, which are the costs of running the plan itself. So when you put it all together, the plan saw an increase of $30,053,000 before any transfers. This is a strong positive indicator. They also had a small transfer of $543,000 to another Kraft Heinz savings plan, resulting in a net increase of $29,510,000. This means the total amount available for employee benefits grew significantly over the year. Now, let's delve into the notes to the financial statements, which provide crucial context. This section explains that the plan's assets are co-invested with other defined contribution plans sponsored by Kraft Heinz in a commingled investment fund called the Kraft Heinz Defined Contribution Master Trust. This is a common practice for large companies to manage retirement assets more efficiently. The report also mentions that Fidelity Management Trust Company is the trustee for this master trust. We learn about how employees contribute. They can make tax-deferred Roth 401 and after-tax contributions for 2025. The limits for direct tax-deferred and Roth 401k contributions were $23,500 or $31,000 if over age 50. This shows the regulatory environment these plans operate in, with limits set by the Internal Revenue Code to encourage retirement savings while preventing excessive tax breaks. SE Cure 2.0 Act of 2022 also allowed for increased catch-up contributions for participants aged 60 to 63. adding another $11,250 in 2025. Kraft Heinz also contributes to the plan in various ways. They offer matching contributions based on employee contributions and also provide non-elective contributions, meaning they contribute a certain percentage of an employee's pay regardless of whether the employee contributes. For eligible employees, there are also age-related contributions, which increase with age, ranging from 2% for those under 30 to 8.5% for those 65 and over. This structure incentivizes long-term employment and saving. Each participant's account is credited with all these contributions, plus investment earnings, and charged with benefit payments and expenses. Participants have the ability to direct their investments, which is a key feature of defined contribution plans like this one. Vesting is a critical concept here. It determines how much of the company's contributions an employee can actually keep if they leave the company. For employee contributions and rollover funds, it is 100% vested immediately. However, for company matching and non-elective contributions, there is a tiered vesting schedule based on years of service. For example, employees previously part of H.J. Heinz Company generally vest after 3 years of service, while those from Kraft Foods Group have a schedule starting at 25% vested after 2 years, reaching 100% after 5 years. This structure encourages employees to stay with the company. This section details how the plan values its investments. The key takeaway is that investments are reported at fair value except for fully benefit responsive investment contracts, which are reported at contract value. This contract value represents the amount participants would actually receive if they were to initiate transactions. It is important to note that synthetic guaranteed investment contracts, or GICs, are included at contract value. This is a common practice for stable value funds. Here is a really interesting part. The plan was involved in a securities litigation settlement. On May 15, 2025, the Master Trust received an initial distribution of $10.2 million related to this settlement. The report mentions that the portion available to this specific plan was not yet known pending an allocation analysis. This shows how large corporate litigation can eventually trickle down to affect employee benefit plans. The report also notes a final distribution of $1.2 million received on the 21st of April 2026, as mentioned in the subsequent events. Let's look at the Master Trust itself. For the 31st of December 2025, the total Master Trust had net assets of over $4.189 billion. The plan's interest in this Master Trust was $331,312,000. That represents a substantial part of the Master Trust's total value. In the Master Trust, investments at fair value totaled $3,968,176,000. This includes a significant amount in collective trusts, registered investment companies, common stocks, and short-term investments. The lion's share, $3,824,977,000, is in collective trust. This is where the assets are pooled. This section breaks down how the investments are valued using a hierarchy: level 1, level 2, and level 3. Level 1 investments are valued using quoted prices in active markets. For the Master Trust, this includes registered investment companies, common stocks, and short-term investments, summing up to $143,199,000 as of the 31st of December 2025. These are generally the most transparent and easily valued assets. A much larger portion, $3,824,977,000, is in investments measured at net asset value. This typically applies to collective trusts where the value is determined by the underlying assets, and these are often not classified within the fair value hierarchy. This is an important reconciliation for regulatory purposes. It shows how the net assets reported in the financial statements differ from what is reported on the Form 5500, which is another regulatory filing. As of the 31st of December 2025, the net assets available for benefits per the financial statements were $341,770,000. After adjustments related to contract value versus fair value for investment contracts and other items, the net assets per the Form 5500 were $340,955,000. The slight difference is due to different accounting treatments for certain investment contracts between the financial statements and Form 5500. The Form 5500 requires investment contracts to be shown at fair value, whereas the financial statements use contract value for fully benefit responsive ones. Finally, let's look at the schedule of assets. This is a critical part where we see what specific assets are held. Interestingly, a significant asset here is participant loans, totaling $8,252,242. These are loans issued to employees from their own retirement accounts, with interest rates ranging from 3.25% to 9.50%. The cost information is not provided because these are participant-directed investments. This indicates that the company offers a loan feature within its savings plan, which can be a great benefit for employees, but also represents a liability in terms of managing those loans. The report also highlights that participant loans and holdings of Kraft Heinz's own stock are considered party in interest transactions. However, these are generally exempt from certain prohibitions because they are either participant-directed or specific statutory exemptions apply. This is a common disclosure for these types of plans. Looking at these numbers more broadly, the Kraft Heinz Union Savings Plan shows a healthy picture for 2025. The plan's net assets have grown, driven by strong investment performance within the master trust and consistent contributions from both the company and employees. The variety of contribution types and vesting schedules are designed to encourage long-term participation. The inclusion of participant loans also suggests the company is supporting its employees' financial well-being beyond just retirement. The involvement in the securities litigation settlement is a notable event illustrating how external factors can impact these plans, but the timely distributions suggest good management. The master trust's significant size and diversified investments also speak to a strategic approach to managing these significant retirement assets. My biggest concern, if any, would be the reliance on the master trust's performance. While it performed well in 2025, any downturn in the markets held within that trust would directly impact employee retirement balances. Also, the participation in the company's own stock fund, while common, carries inherent risks tied to KHC's performance. It is vital for participants to diversify beyond company stock. What I am actually looking for is continued growth in net assets and a steady stream of participant contributions that suggest ongoing engagement with retirement planning. Alright, that is our breakdown of the Kraft Heinz Union Savings Plan's latest filing. What is your take on these numbers and what they signal for the company's retirement management? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time. That is my take. Stay decoded.